before we dive into the reports, let's make sure we cover the macroeconomic viewpoints because inflation and interest rates have a major impact on the real estate market. So right now in the United States, inflation came in from 7.1 to 6.5%. So there was a beat in inflation. There was actually just a slight hint of deflation in the US, and that saw the bond yields rally lower, which will have an effect on your 5-year mortgage rate. Here in Canada, we actually went from 6.8% to 6.3% in our most recent reading, which also beat expectation, which rallied bond yields down even further. So that's two really good pieces of news there. I know inflation's still high, but the trend is starting to show that we're coming down, and a lot of economists believe that we're going to continue to go down. However, there was a recent jobs report that came out that showed that the Canadian economy was still overheated. So that's going to give the Bank of Canada the ammunition they want to potentially raise interest rates. Again, most economists are predicting that we're going to get another quarter basis point hike, which will see essentially a 0.25% increase in all your variable rate mortgage products. If you're on a fixed rate, that won't affect your rate. The next dates you're going to want to mark in your calendar is January 26th. So that's when the Bank of Canada will be meeting to either raise rates or not raise rates. So that's the one you're going to want to pay attention to, because if you are on a variable mortgage, your interest rate will go up that day if they raise rates. And the next inflation reading is coming not for at least another month, February 21st. So we have over a month to wait until we get our next inflation reading. With that being said, that covers the macroeconomic viewpoints. So let's see how that affects the real estate market. All right, so let's put a bow on 2022. So let's just start with the supply. In the supply side, we had 3,300 units come to the real estate market, which was the most since 2016 or since I've been tracking. So we had a healthy amount of supply come to the market. On the outflow side, however, though, on selling listings, for the very first time since I've been tracking, we have sold under 2,000 units. So the Guelph real estate market is very consistent, selling well above 2,000 units every single year, no matter what market we're in. However, 2022 was the first time ever that I saw that units were under 2,000. So we definitely had a shortage of sales last year. And as you can see here, just in these numbers here, right, we had 20% less sales, 25% sales, 40% less sales, 38% less sales. And then in December, to wrap it up again, another 30% less sales. However, on the failed sales side, look at this. We hit 4 digits, quad digits here for the very first time ever. 1,227 homes failed to sell in 2022, which is the most ever. The only other year we had that many homes fail to sell was in 2018. So again, a pretty interesting market here. A lot of homes fail to sell. So let's just put a bow on it. Here is the monthly average sold price. So in December, we ended at 734,000, just down 0.25% from the month previous. And from October to December, the market dropped a total of 1.8%. So it looks like the market has definitely stabilized. The biggest fall is behind us. As we can see here, from April to August, we dropped 23%. And from the peak to December, we dropped 27%. And just in the last 3 months, it was 1.8%. So it looks like things have definitely stabilized. I'm going to jump into the January report in a second here, which will show you some interesting information. So this is just a summary of what I've shown. You know, the 2,300 units, up 7% from our 5-year average, 1,900 units sold, down 16% from our 5-year average, and 26% from last year, which is crazy. And our failed sales up between 70% on our 5-year average and 163% from last year. Pretty wild. But we still were able to manage to add 111 units to the market in 2022, which was much needed. And we'll dive into that a little bit later. But just to look into this, so we started with the year with suppressed inventory. We rebuilt our inventory back up. We had a little excess inventory here in July and August. And then we kind of came back to our normal levels. And we're kind of right around our normal levels, but based on our 5-year average for inventory. So what's really interesting to see is that we're still in a balanced marketplace, and we'll get more into that in the other video. But what's really interesting here is that with 40 to 35 to 45% less sales in a typical month, we only have average inventory levels. So in a typical scenario like this, where an abundance of supply is coming in the market and less sales are happening, you would expect that we would have much more inventory. We're talking maybe 30% more inventory than we do right now, but we're just at our averages. So I do feel if interest rates do change winds, and we'll cover that in the interest rate report, there's going to be a big swing to the purchasing. A lot of people are going to be buying and then putting pressure back on the real estate market. Okay, so that pretty much wraps up 2022. And let's jump into 2023. All right, we're going to kick off 2023 with an interest rate report. So I just want to cover what's going on in the interest rate market and when we covered about the macroeconomic factors, how that affects what's going on. So as you can see here, I'm going to explain the difference between a variable rate mortgage and a fixed rate mortgage. So just bear with me and how the bank's pricing these interest rates. So for example, the variable rate mortgage right now is sitting around 5.45%. So how do we get there? Well, right now, the Bank of Canada's prime interest rate, which is potentially going to go up another quarter point, so to 4.5%, is what the Bank of Canada's key lending rate is. The typical banks like RBC, TD, Scotiabank, etc., usually want a 2% spread on that. So if it's 4.25 at the Bank of Canada, RBCs and TDs and the BMOs of the world are going to offer 6.45% as a prime rate. So that's about a 2.2% spread right now between the Bank of Canada's rate and the typical bank rate. So you're about a 2.2, which is a little bit higher than typical. So they're maybe a little extra greedy right now. As you can see here, if the best rate is 5.45%, then the best offer in the marketplace, if the prime bank rate is 6.45%, is prime minus 1. So the best the banks are offering right now is bank prime rate at 6.45 minus 1%, which will give you a 5.45%. So how could that go down? Well, there's a couple ways that can go down. Is if the Bank of Canada drops their interest rate, their key lending rate, which is likely not going to happen, it's going to go up, or the banks reduce the spread that they're willing to take on that key lending rate. So for example, if they're willing to take a 1.75 or a 2% spread, that will also potentially drop the 5-year variable. Other banks could increase their prime discount, so a prime minus 1.2 or a prime minus 1.5. We could see here we had prime minus 1.2 earlier on when banks were a little bit more aggressive in lending. So right now, it looks like there's not a really great deal on variable rate mortgages. The only reason you'd want to take a variable rate mortgage right now is because you believe that in the very near future, if you can get prime minus 1, which is what you're getting right now, if the Bank of Canada reverses their interest rate trends and drops interest rates down back to near zero where it was pre-pandemic, for example, you could be almost getting interest-free money, right? So that's the gamble you take on going variable. However, if you take a variable, you can also go the other way where they continue to raise rates to fight inflation, and then they're just going to come back down to where you are now. On the flip side, let's cover the fixed rate mortgages and how that is affected. So the fixed rate mortgages are dependent on the bond yields. So here's the 5-year bond yield rate that we currently have. So that's the numbers that we got. And currently we're sitting at 2.8%. And as you can see here, anytime banks got close to a 1% spread, so if the 5-year bond yield is 3.3%, the banks are going to want a spread from the bond yield to what they're offering customers. However, when it gets down to 1% spread, it looks like that's a trigger for banks to increase their interest rate. So for example, here we went from 4.45, 4.34%. Bond yields were going up, however, so there was a spread of only 1, so they triggered interest rates to go up to 4.6%. Here again, bond yields continue to go up, and then here we're at 3.68%. So again, there was only a 1 point spread, so that was an indicator for them to bump rates up again. What's happening now? Well, interest rates are falling on the 5-year fixed. Why is that? Well, as you can see here, the bond yields went from 3.29% all the way down 2.8% now. And the mortgage rates have steadily fallen since then. And what we can expect, since we have such a healthy margin between the bond yield and what the banks are offering customers, currently we're sitting at a 1.74% spread. So if that's the case, we can likely expect that the banks are going to drop their 5-year fixed again. So if the 5-year fixed keeps falling, you can definitely feel like there's going to be more stability in the real estate market, because with the prices dropping almost 30% from April 2022 to December 2022, and now the interest rate's now coming down, you can expect that that purchasing power and the purchase price decrease is meeting in the middle and finding that demand zone where buyers and sellers are willing to come together more often at the price that we're currently at. So what is the best advice for you on just interest rates? So, if you are thinking about buying in the next 4 months, one of the best things to do would be to lock in a rate hold. So, example, you go to Frank Mortgages, for example, and you lock in a rate hold because then you're guaranteed if anything happens in the economy and shoots interest rates back up, you're guaranteed to be holding these lower rates. On top of that, if rates go down, you're not obligated to hold that rate. So, say for example, right now, you wait maybe 2 weeks to see if this bond yield here at 2.8% drops the interest rates. So, I'll be doing another report back 1st of February. And if this low bond yield holds true, I can probably predict that interest rates will come down even further to when we were at 2.8% back in August. So another tenth of a point. We're probably looking around 4.34% is where the interest rates could fall in 2 weeks if this 2.8% holds on the bond yield market. You can check the bond yield market by going to the website, putting in the 5-year Canadian bond yield, and you can track what's going on right there. As you can see here was the low in August. We're pretty much at that low right now again. So you can feel pretty confident that the banks are likely going to drop their 5-year fix to around 4.34%. So the best advice I could give right now to someone trying to lock in a decent rate on a 5-year fix, get a rate hold. And that way, and maybe just wait to see if the interest rates just drop a little bit more. Get the rate hold, and then if you do get the rate hold, you're guaranteed that rate even if rates go up. However, if rates go down further, you can get the best mortgage product on the market at that time. So it's literally just a hedge against future interest rate increases. So if you have any questions about that, feel free to reach out or go to Frank Mortgages. We'll have the link in this video or anywhere else that you might see this video online. All right, so hopefully that covers the interest rate report for you, and I hope that information was valuable.